As a continuation of our discussion on common estate planning trust, today we're going to dive more into the gift tax element that can pop up when you're funding an irrevocable trust. This is a presentation for individuals who want to implement or update their estate plan, advisors who want to understand more about trust planning, or attorneys who just simply want to brush up on their skills or learn more about the basics of estate planning. So, it's been a while. I went on vacation, but in episode 211, before my vacation, we covered some of the general issues that can pop up when funding an irrevocable trust during life or at death. So we're going to kind of dive more into those issues before we get into those mechanics now of funding. So this episode is going to introduce the concept of transfer taxes and explore where the gift tax might apply. I'm Griffin Bridgers, and this is 10 Minutes with Griffin. Today's episode, episode 212, is all about gift taxes as a continuation of our discussion on common estate planning trusts. As always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. A little bit about me. I provide tailored estate planning and tax education to the legal industry and to the financial planning industry. I also offer services as an estate planning attorney with the law firm of Hutchins & Associates. So, in both those parallels, if you'd like legal services and you're a client in Colorado or Tennessee, you can reach me at gbridgers@hutchinslaw.com. If you want to learn more about my estate planning services that I can offer, you can reach me at griffin.bridgers@gmail.com. Now back to the presentation. So, in episode 211, we looked at some common methods in theory of funding an irrevocable trust. Recall that a transfer to an irrevocable trust is permanent. That's why it's called irrevocable, because you can't revoke the trust or revoke any transfer to the trust. So, the main methods of putting assets into an irrevocable trust were: one, by gift, which is simply a one-way transfer, where nothing is received in return for the transfer to the trust. Another thing is by sale, or another method is by sale, where the property of the trust is given back to the transferor in exchange for whatever is being put into the trust. And typically a sale will be equal value, and you can mix the two worlds. You can have a transfer that's by both sale and gift, where you give away more than what you get back from the trust in return. So today we're going to really focus on: one, an introduction to transfer taxes, and two, the tax that can apply where there's a gift during life, either where nothing is received in return or where you have a part sale, part gift, where you give away more in value than what you get back. Now, this hypothetical you I'm referring to is the settlor, the person who creates a trust or funds a trust. And we'll get back into that definition in a minute, but I think it's good to take a high-level view of tax and how that applies federally to gifts and inheritances. Now, we're only focused on federal tax here. We're not worried about state tax, just because there's too many rabbit holes we can go down if we look at state-specific taxes. Now, if you're the recipient of a gift or an inheritance, whether it's direct or in trust, then generally you're not going to owe any federal income tax on that gift or inheritance. But that doesn't mean that that gift or inheritance is received tax-free. Instead, what that means is that instead of the recipient being taxed on that gift or inheritance, instead, the IRS looks the other way. The IRS imposes a tax on the transferor, i.e., the person making the transfer. Because of that, this is commonly known as a transfer tax. And there's two specific transfer taxes that really come into play. One is a gift tax that applies to transfers during life, or an estate tax that applies to transfers at death. Now, in parallel to those, which is a little bit beyond the scope of today's discussion, there's also potentially generation skipping transfer taxes, and that only applies where any actual or potential beneficiaries of the irrevocable trust are two or more generations younger than the transferor. Now, this is really just another layer of gift or estate tax, but with different mechanics, and we'll discuss this in a number of later episodes. Now, the gift tax really centers around a couple main categories of exclusions, which are designed to keep you from having to pay gifts unless you're intentionally trying to transfer a large amount of wealth to somebody else. Now, as a reminder, we're looking at irrevocable trusts here. The only time you're going to have a gift tax issue is when you're making a permanent transfer, and a permanent transfer is to an irrevocable trust. So we talked about revocable trusts a long time ago. We're not worried about gift tax or even a estate tax with those. Those are going to be transfers that are ignored for tax purposes. But this is a transfer that might be respected for tax purposes, at least on the gift or estate tax side. So when the settlor, i.e. the creator of the trust, puts property into that trust, then that's a gift by the settlor to the trust beneficiaries. Now, where things get hairy is that we have this gift tax annual exclusion that applies each calendar year to each recipient of a gift. And the donor, or the settlor in this case, all these terms are interchangeable between settlor, donor, or transferor. But in this case, we're going to refer to the settlor, the person putting property into the trust, and the settlor potentially has the ability to get an annual exclusion every single calendar year for each trust beneficiary. But the ability to get that exclusion is dependent on the type of trust interest that they give. Now, typically, transfers to an irrevocable trust are going to be treated as future interests. And the only significance of that term is that it keeps you from getting this gift tax annual exclusion. In order to get this gift tax annual exclusion, which is $15,000 per trust beneficiary potentially, then you have to structure the trust interest that each beneficiary gets as a present interest. Now, it's too complicated to really dive into that in detail here. This distinction is best left to an attorney. Now, if you exceed that annual exclusion for any one beneficiary, then there's also a lifetime exclusion you get against your gift tax. This amount is $11.7 million, and this isn't per calendar year. This just looks at your entire lifetime. Now, this exclusion also applies to the estate tax, and they are calculated together. It's a cumulative calculation for your lifetime gifts and whatever you have left in your estate at death. So whatever portion you use for lifetime gifts generally will reduce the amount that you have available at death. So for example, if you have $11.7 million in exclusion and you give $5 million to an irrevocable trust during life, that uses up $5 million of your lifetime exclusion. What that means is that at death you'll only have $6.7 million remaining of that exclusion to offset estate tax. Now, mechanically, this isn't a direct subtraction from your gifts or from your estate. This is applied as a credit against your gift or estate taxes. So every year, you'd calculate the gift or estate tax first, then subtract the amount of gift or estate tax that would be owed on the exclusion amount of 11.7. That's how that applies, and you don't need to worry about the mechanics of that because on paper it works out to really the equivalent and more understandable function of exempting the first $11.7 million of lifetime gifts and transfers at death from any sort of transfer tax. Now, taxable gifts are a term that we give to transfers that are subject to gift tax that might use that lifetime exclusion or might be subject to actual gift tax out of pocket once that lifetime exclusion is used up. So to get your taxable gifts, you have to subtract out certain types of transfers that are excluded from the gift tax. First, are transfers that qualify for the gift tax annual exclusion of $15,000 per beneficiary, if we can get that exclusion, which we'll cover in a later episode. And there's also a couple other things we'll cover in later episodes: the marital deduction for transfers to a spouse that qualify, and also the charitable deduction for transfers to a charity that qualify. So only taxable gifts will use the lifetime exclusion. Any gifts that qualify for that annual exclusion or any of these deductions won't dig into that $11.7 million lifetime exclusion. So just to kind of set the stage for what's coming, one big question I often get from clients is whether, as a settlor, can you be a beneficiary of an irrevocable trust? And you can, but that's going to cause issues for both gift and estate tax. Now, technically, you only pay gift tax on gifts to other people. You can't pay gift tax on a gift to yourself. But there's an exception to that can pop up in an irrevocable trust. Because within an irrevocable trust, it's hard to separate the value of what you retain for yourself versus the value of what's given away to other beneficiaries of the trust. And the answer to that question of whether you can separate that value is generally no. You cannot unless you structure the transfer in a certain way. And even if you do structure it in a certain way, if you are a beneficiary of a trust that you create, whether it's irrevocable or revocable, upon your death, the IRS will charge estate tax as if you owned the property in that trust at the time. So not only do you have an issue of the value of what you keep versus what you give away at the time of the gift, you can also run into a value issue of what you keep versus what you gave away for estate tax purposes as well. But either way, estate tax and this concept will get covered in later episodes. As always, if you have non-client specific questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. But thank you for listening to this episode of 10 Minutes with Griffin, and I look forward to seeing you in the next one.